Good afternoon and welcome to this edition of FCS Financial's Grow Together webinar series. Thank you for joining me. I'm Madison Farnan, Manager of Marketplace Engagement with FCS Financial, and I'm excited to have you here today. Today, we're going to tackle a topic that many producers accidentally leave on the back burner: mid-year moves for year-end tax savings. By the time December rolls around, your options for shifting income or maximizing deductions have narrowed, and true tax strategy can happen now during the summer growing months, and we want to give you clear framework to help protect your hard-earned revenue. For today's sessions, cameras and microphones have been disabled, so please use that Q&A feature to submit questions throughout our session today, and we will take additional questions at the end. Additionally, a recording and the presentation slides will be shared with all registered parties via email later today. Joining us today to share her expertise is Jessica Lehman. Jessica joined Williams Keepers LLC in 2008, having graduated summa cum laude from the University of Missouri with a bachelor's degree and a master's degree in accountancy. Jessica specializes in tax accounting services for businesses and individuals, including an emphasis in state and local taxation, agribusinesses, and retirement and employee benefits. She is a member of the American Institute of Certified Public Accountants and the Missouri Society of Certified Public Accountants. She also serves her community on the board of the Columbia Center for Urban Agriculture and the committee of the Heart of Missouri United Way. Jessica brought fantastic insights to our members when she spoke with us last winter, and we are thrilled to have her back to kick off a one of two part of our tax planning series for 2026. Jessica, I will hand the floor over to you. Thank you.
Thank you, Madison. I'm happy to be here. Good afternoon, everyone. Thanks for taking time out of your busy summer schedule to be here with me. I love working with farmers and agribusinesses because it feels like home to me. I grew up on a farm in mid-Missouri myself. So my goal today is not to add to your never-ending to-do list, but to give you some actionable items to help get you prepared for year-end, which hopefully results in real tax savings when December rolls around. We'll cover what you already know today, a summer checklist to build on that, and how to walk into your year-end planning meeting ready to go. Let me get my slides shared real quick. All right, there you go. So our goal is to save you tax, but if you can't save you tax, I as a CPA at least want to make sure my clients are not surprised. It's not ideal when someone comes in thinking they know what they made, and then they discover some things that weren't previously accounted for, and the actual results are far different from what you planned for. This is particularly annoying when the situation could have been avoided if better information had been available before year end. So today's focus is the simple idea behind everything we cover is trying to reduce your taxes by starting early and being ready to make better decisions before and during your year-end planning meetings. So let's start by building your baseline. I know there's so much about the rest of your year that you just don't know about yet. You don't know what the weather's going to be like tomorrow, much less in a couple months. You don't know what happens to commodity prices. There's so much unknown. I would never expect a farmer to project out their year by annualizing their financial results through June, like some businesses can do, because we just don't know. So what we want to do is we want to focus on what you actually already know right now, today, sitting here in the middle of the year. So what do you already know today? What can you pull together to make everything easier to finish pulling together later in the year? You've got more information available right now than you really even think. So start with your existing obligations, your current debt payments, any major lease payments due through the year for equipment or land. Keep in mind what you need to pay yourself in reasonable compensation if your structure requires that. A lot of people wait towards the end of the year to handle that piece when they're the only employee. Then take a look at your prior year activity. You might need to ask your CPA if you don't already have this, but they do already know how much your current year depreciation is on any prior asset purchases, and they can provide you that number. These are things that are deductions potentially that might not be causing you to pay cash this year. So when you're tracking your cash standing, you wouldn't be noticing these things. Your CPA would also know if you had any prior year losses or credits you're carrying forward. And it's important to plan for those too. So you factor in that deduction when you're thinking about prepays and recognizing income at year end. And finally, your current position. What grain do you still have in storage? Do you know you're going to need to make state pass-through entity payments by year end if you're a partnership or an S corp? Have you planned for those? Whatever other requirements come along with how your entity is structured. For example, if you've got a C corp that pays rent to you as an individual, we'll talk a little bit more about that later. So why do all these things matter? You already are probably well aware that cash did not necessarily equal taxable income. But we just want to emphasize that because so often you're looking at a cash balance to assume or to calculate your performance through the year, and it just doesn't turn out to be exactly the same thing. So you need to watch out for those loan payments, depreciation items, stuff like that, that doesn't tie the cash to the taxable income. Keep in mind the prior years still impact this year. We want to be thinking about that all the time. And keep an eye out for your entity structure. Like the example I gave before, if your operation is in a C corp, but you rent land from yourself as an individual, you have two completely separate tax-paying entities. One has income, one has deductions, and those two can't offset because they're different entities. So in situations like that, you need to do some extra planning today just to make sure you're not caught in a situation you don't like later on. All this feeds into the decisions you'll make later this year, but we just want to set the stage today or as soon as you can so that you're ready to make that decision at that time. So let's think about a summer checklist. And again, I know your summer is full of lots of things that need to get done. And a lot of times the financials and the tax planning get on the back burner. So these are just some simple things to just keep an eye out in the meantime, knowing that it's really not, burning issue today, but the time will come sooner than we would like that you'll need to have all this information together. So use a slight lull if there is one in the planting season, use a series of rainy days to help you get caught up on a few of these things. So what should you start gathering? First, equipment. Keep really good records on all your purchases, your sales, all the financing documents if you didn't pay cash. And if you're trading equipment in, really pay attention to both the trade-in price and the total price on the new equipment, not just the cash you paid out of pocket. So say you trade a tractor worth $200,000 for a new one priced at $300,000, and you write a check for $100,000. Easy math. A lot of people think their basis in the new equipment is $100,000, the cash they paid. It's not. It used to be before the TCJA in 2017, but for the last several years, it doesn't work that way anymore. Now your basis in that new tractor is $300,000. So instead, you have a $200,000 sale of the old tractor that's taxable gain, a $300,000 new tractor to depreciate. For the most part, these offset. But when you're providing information to your CPA, it can get really confusing unless you've presented the information in a way that's easy for them to know this is what I traded in, how much I received on that trade, and then this is the full purchase price. So keep that in mind and provide the whole set of information to your CPA. Next, revenue. So you obviously need to know what your income is. Track the grain you sold, maybe the grain's still in storage, so you have an idea of, what you will have to sell before the end of the year. Keep an eye on major livestock purchases, whether they're breeding or feeding stock, because those have different tax treatments for the deductions. And also any major livestock sales. And remember, livestock sales can be either ordinary income, if it's something that was born, raised, sold as soon as it was at market rate, or it can be or market weight, or it could be 1231 capital gain, depending on whether the term, what the livestock was used for and the term that you held it for. So typically breeding stock that you held for a longer term can get that capital gain treatment. And you're going to want to get that benefit on your tax return. Not only do you get a better federal tax rate for capital gain, Missouri doesn't tax capital gain anymore. So if you're a Missouri resident, you really want to make sure you're keeping track of those. And then obviously don't forget your government payments and crop insurance proceeds either. So expenses and labor. Everybody knows you need to keep track of your expenses. But some extra things to watch out for is to pay attention to your prepaid inputs. So if it was something that you prepaid in December of 2025, it's easy to accidentally double count those when you count your 2026 expenses, because especially if you wrote a check, you might have paid it in December, but you didn't actually have the check clear the bank until January 2nd or something. So make sure that you're not double counting those. And then keep track of your contractor payments so that you're ready when 1099 prep time comes. So get those W-9s collected now rather than having to chase them down later. The threshold for 1099s, this is good news that came out of the Big Beautiful Bill Act passed last summer. The threshold for 1099s is now $2,000 instead of the old $600. So hopefully you have a few less that you have to issue. Nobody likes sending out 1099s. As a reminder to those who are receiving them, just because it's under 2,000, it's still taxable income, even though you don't get a 1099. But this just makes the compliance a little bit easier. If you have employees, make sure you take note of any new ones and make sure you're up to date on what you need for payroll reporting, W-4s, and all that stuff. Sometimes if they don't have any Missouri withholding, you really don't have much reporting you have to do to the end of the year. So it's easy to push that along and then realize you're missing something in January. And then if you have a retirement plan for your employees, now is a good time to make sure you're thinking about what contributions you need to be making and getting them done timely if that's the case. If you don't have a retirement plan for your employees or yourself, now is also a really good time to talk that over with your CPA, just in case you'd really like to add one. It's a good way to save taxes by spending the money on yourself. So if you use QuickBooks or some other tracking software, use whatever slight breaks you have this time of year to see if you can get caught up on those things. So that way, when it's time to do December year-end planning, you're not doing 11 months worth of catch up. You're only doing 3 or 4. Your December self will appreciate it if you can manage to fit a few of those things in during the summer. Your CPA from the prior year probably gave you some adjustments, or maybe they didn't give them, but they probably made some adjustments to your financials. So if you didn't get them from your CPA, ask for those now. They'll really appreciate it if you can have those adjustments made before you come in at the end of the year, because it'll just streamline the process then. They'll be very happy you're taking care of it. And if you honestly decide that bookkeeping is not a good use of your time, there is no downtime, there is no summer lull, you'd rather just pay someone else to do it, now is the time to seek help. You'll have a lot better chance of getting somebody that can help you get caught up timely to make year-end decisions and file your tax return if you start with them now rather than asking in December or even worse, February, when everybody else might be asking to. It's totally okay if you don't want to be your bookkeeper. Spend the time on the thing that makes the most sense, where you can make the most money. And maybe sometimes professional help might be the way to go on this. So something else to consider before the end of the year is estate planning. So if you're at a stage in your life where you're doing yearly gifting to help draw down your estate or something like that, you could go ahead and start thinking about that now, so you're not rushing to get that done in December. And then if there's structuring or transition conversations, you should be starting now so you have time to act before year end. Let's do it, because you hate to rush something through with your attorney or whoever in the last few weeks of December. So now's a great time to get those conversations started. So other items just to talk about early to make sure that you're prepped and ready to go. Major repairs, building projects, land improvements. These all get classified differently depending on the specific details. So the sooner we know about them, the better we can plan. It's a really hard pill to swallow when you're spending money thinking you're getting a deduction for it, and then you find out too late it might not have been deductible in the current year, and then you have to spend more cash on taxes. Some improvements just simply aren't deductible at all, and many have to be placed in service before the end of the year if you want to get the deduction. So your CPA can help you figure out what placed in service means based on the specific project that you're talking about. And they can also help you determine if it really is a repair or a capitalized improvement. But for example, if you're pouring concrete for a new grain bin in November, but you're not going to be able to complete the bin until January or even until it warms up a bit in the spring, that deduction is going to fall. Even for the concrete that you paid in the fall, that deduction is falling into the next year, not this one, even though you're out the cash. So keep this in mind, talk to your CPA early, make sure you can plan to get the deductions in the year that you need them. So all of this now is, the goal of this is to prepare for better year-end meetings. So let's talk about what you need to be doing before the beginning of December to make sure you're ready when it's time to meet with your CPA at the end of the year. So what should you bring to those meetings? Bring up-to-date financials or at least electronic access to them. Bring an estimate of the income you've generated up until that point, and also how much you think you can generate for the rest of the year. A range is not just fine, it's actually preferred. I'd love for my clients to come to me and say, I think I can sell an additional this to this, 100 to 400,000 of grain. What's the optimal tax position? And we can talk through that with them. Or how much should I prepay? We can talk through that too. We want to talk at that meeting. Sorry, I went too fast. We want to talk at that meeting about the equipment that you've already purchased and sold. And that'll help us decide if it makes sense that you purchase or buy anything else before the end of the year. And here's a key thing we often don't think about, but it'd be a great idea to bring confirmation of all your major loan balances to talk through with your CPA. It's very important because it's how we find things that you may have forgotten to mention because you didn't spend cash on them. So for example, equipment purchased with a new loan, but no loan payments until the new year is something that commonly gets missed as a deduction on a tax return. So if you just give us a check register, we don't see anything indicating there was a purchase, there was no loan payment. So if we know the state of your balance sheet, which includes all your loan balances, then we can help point out that, hey, there's a new loan here, or this loan balance increased. What'd you buy with that? Did we count that? You don't want to lose the benefit of that deduction. And then have a good idea, kind of like I talked before, about the grain, livestock, whatever else applies that you're holding and ready to sell. So if you have all this information available and you go to meet with your accountant at the end of the year, they're going to be much more well-equipped to help you with the questions that you really care about. So year-end planning is not really the time to be just gathering all the information. Well, we can do that, and we'd rather do it in December than February. It's better if all the information is already gathered and we can really talk through with good confidence in your numbers some of these questions. So should I prepay additional expenses? Should I buy equipment? Should I accelerate grain or accelerate sales, or maybe even defer them into next year? Am I going to be able to afford the tax bill that I'm looking at? So the better the inputs can be, the better the planning options from us are. Just gives us a lot more opportunity to use what you have and give you concrete advice rather than guessing based on partially completed financials, which I know it's always a rush. You're busy today, you'll be busy in November. There's never a free time to get this done. But the more in advance it can be done, the better for everyone. So the big takeaway here is that we don't want you waiting until December to start pulling information together. But I also absolutely would never suggest you waste time trying to predict what the few months are going to hold. That's just not worth it. So the items that you can pull together today are what's happened year to date, and those fixed items that we know are going to happen regardless of your operations for the rest of the year, like we talked about, the loan payments, the rent payments, the reasonable compensation you have to pay for yourself. Again, pull that all net together now, have an early conversation just about some questions you might have with your CPA as you gather those, and we'll be so much more prepared to help you out and actually save taxes at the end of the year. So that's all I have for my slides. I'll turn it back to Madison if any questions have come in.
Thank you, Jessica. I am really appreciative of you just sharing all of this information with us now versus right at year end, because there's a few notes that I made to take away that really just allows me to be better prepared now when I have a little more free time than the hustle and the bustle of year end and with the holidays. So again, as Jessica said, I want to take this moment to open up that Q&A for any questions and information that she's presented on today, or things that maybe you've heard about for her to answer. So feel free to submit those in. Jessica, I do have a couple questions while we wait for any other to come in from our audience today that we frequently hear from producers across the state. And one of those is that we are specifically in the heat of the summer fair and show season for many ag youth participants. And so there's recently been a change to the 1099 IRS rule specifically for 4-H and FFA exhibitors. Would you mind sharing a little bit about that? Because that may hit a few of the parents that we have in our audience today.
Yeah, so keep in mind the 1099 rules, the main thing that changed is just the income threshold. So whereas before it was 600, now it's 2,000. But I know back in my day, I never received a 1099 when I sold my steer at the county fair, but that doesn't mean that they're not doing it now. I think the IRS and all the payers are just being a lot more careful. The payers are being a lot more careful because the IRS pays more attention to whether 1099s are issued than they used to. So your 4-H or FFA exhibitor might be getting a 1099, and there's some things that you need to keep in mind. So first, just because you get a 1099 doesn't mean that's the exact amount of net income that you have to report. Remember, they probably had expenses related to that. So an example of my steer at the county fair, I had to buy the steer, I had to pay for the feed, all that stuff. It's great. It's a great example of, number one, there's expenses to deduct, but also it's a great opportunity to teach your exhibitor that they can start gathering this information early so that they have the information at the end of the year to reduce their tax load. So it's a good part of the experience for them, and the learning experience. Something to keep in mind on those is just because you get a 1099 for it and maybe you have net income after all the expenses, whereas for a farmer, the net income from selling something is subject to self-employment tax usually. For these exhibitors, they may not be, because if it's under a program that's specifically educational and you fit the requirements of the sponsoring organizations, you may not have to pay the self-employment taxes. So watch the specific situation, ask questions of the CPA if you're having one help you put together the tax return for your kid, and just keep that in mind. Also, like I said earlier, just because you don't receive a 1099 doesn't mean it isn't taxable income technically. So no matter whether the payment is $2,500 or $500, it's a good time to be teaching them to keep track of their income and expenses so that can be reported at the end of the year.
Awesome. Thank you. I knew it was very timely. I had read a few things about how that could be impacting the youth now. And like you said, this is a great time. youth in ag learn a lot by having their own livestock and projects, and so this is just another way to help prepare them as they grow up to become adults. Very good. Again, opening up the Q&A for any questions. I do have another one for you that we do hear quite a bit still along that 1099. So for operations that are hiring independent contractors or seasonal labor this summer, why is it so critical to secure a W-9 right now rather than waiting till that January 1099 prep time?
Well, partially it's just because you're making it easier on yourself, giving you some more time to get responses back. But best case scenario, you don't pay anybody until you get that W-9, because a lot of contractors don't want to get the 1099 from you. And so it's a lot harder after the fact when you've already paid them. If it's not somebody you're hiring again, sometimes you don't get responses from them on the 1099s. And it's still your responsibility to report it. So you really need that information. So send them that W-9 and say, hey, fill this out and I'll issue your check, is the best case scenario. If it's too late, just get started now and do what you can. But that's really the best case scenario. And the IRS has, their computer systems are better at matching mismatched ID numbers and recipient names and everything than they have been before. So to the extent that you issue 1099s that aren't accurate, you're more likely to get notices now telling you, hey, if you ever pay this person again, you either need to correct it or you need to do backup withholding for them. And nobody wants to get into doing backup withholding. That's a pain. So do yourself a favor and ask for it before you pay them the first time if you can.
That is a good tip and trick to just remember this time of year. Great. I'm not seeing any other questions, and so I will go ahead and get us closed out for the day. Jessica, thank you for taking the time to join us, for sharing those insights. I will go ahead and put a plug in. Jessica's going to be back with us again this December for a longer session. It'll be more of a deep dive into a part 2 webinar focused on the final year-end tax execution and that year-end planning portion. We're going to do that at the beginning of December. So if you want to be on the lookout for that, we will be sharing that information out closer to time. But I wanted to go ahead and just say that. So as we conclude this afternoon, thank you again for joining us. I am going to share a link there in the Q&A session. This is a survey link. What that does is that allows us to take about 60 seconds of your time to provide the feedback that you have for us to help us deliver more high value sessions. So if you don't mind, take a few minutes to fill that out, and then keep an eye out on your inbox here. Later this afternoon, we'll be sending out a direct link to today's recorded session, as well as the slides that Jessica prepared and shared with all of us. That way you can reference those at your own pace. Again, that survey link will be in there. That is just really helpful for our team to be able to provide these with timely topics and informational sessions. And then I will go ahead and let you know that our next session of the Grow Together webinar series is scheduled for Wednesday, September 2nd. It's going to be at 12:30 p.m. and we'll be joined by Wesley Tucker. He's from the University of Missouri Extension, and he's going to share a little quick masterclass with us on the Farm Legacy Roadmap. So navigating your estate and succession plan. So he'll talk a little bit about the critical difference between transferring physical assets versus your daily operational management and how to help protect your family's multi-generational legacy. So look forward to seeing you on September 2nd. Thank you again for joining us today and for being part of the agriculture community. Have a wonderful afternoon.